Look at a standard price chart without any context, and this is what you see: a turbulent, jagged storm of data. Every sudden drop or unexpected spike triggers a biological panic response. If you start with a $100 account and try to trade based on those emotional swings, the market can drain your balance in days. You react, you guess, and you lose. Professional trading focuses on something else. It isn't about predicting every microscopic movement. It is about building a rigid system designed to navigate this volatility through rules rather than intuition. Before you even attempt to read a trend, you have to insulate your account. Without strict parameters in place, the noise of the market will likely overwhelm your capital before you ever spot a real opportunity. This diagram shows the first layer of defense, a strict 1-to-3 risk-to-reward ratio. For every dollar you risk, the setup must offer at least $3 in potential profit. This means one winning trade absorbs the impact of 3 consecutive losses. This 20% risk allocation is aggressive, favoring rapid growth over conservative preservation. The math is designed to allow the account to recover from a string of errors that would be fatal to most small balances, provided the risk-to-reward ratio is maintained. As the balance grows, the 20% risk scales with it. $100 becomes $160, and the next risk parameter is based on that new total. By compounding the wins, the account begins to move through a much faster growth curve. Because one single clean setup pays for multiple mistakes, the intense pressure to be right every time is completely removed. You move from a state of simple survival to a framework built for growth. With the math in place, we can address the chart itself. The process relies on systematic filtering, stripping away bad data until only the highest probability setups remain. The very first filter is market structure. Think of structure as the overall current of a river. If you swim with the current, you move more efficiently. Looking at this chart, the smooth, upward sloping line is the 50-period exponential moving average. When the jagged price action stays consistently above this moving average, the high time frame structure is an uptrend. This establishes a strict, non-negotiable trading rule. Since the structure is moving upward, you ignore every signal suggesting a sell. Those setups are entirely filtered out. By identifying the dominant direction, you stop fighting the broader momentum. You save capital that would otherwise be lost on counter-trend trades that have a lower statistical chance of success. Once you know the direction, you need to pick your specific location. You only execute trades on designated battlegrounds. These specific locations are called key levels. They are historical zones, like supply and demand areas, where aggressive price action has forced a significant turn in the past. This diagram shows a fair value gap. It occurs when a sudden surge leaves an empty space between the first and third candles. This gap acts as a target, often drawing price back to retest that specific zone before the trend continues. You mark these levels on your screen, and then you wait. If the price is wandering between these zones, you take absolutely no action. This second filter eliminates the dead space on a chart. It restricts your entries to the specific areas where price has already proven it reacts with significant force. Reaching a key level is a signal to pay attention, but it isn't a signal to trade. Before putting capital at risk, you need proof that the level is actually holding. We find that proof using the volume oscillator. It measures the force behind the current move, showing if a reversal is backed by real activity or just a weak fluctuation. The final tool is the Heikin Ashi chart, designed to clarify price movement and reveal the underlying momentum. Notice the difference. The left side shows raw, contradictory price action. The right side uses the Heikin Ashi formula to filter false moves. You are waiting for a transition at your key level, shifting from thin, indecisive shapes into solid, flat-bottom directional blocks. That visual transformation is your exact trigger. When you see a strong Heikin Ashi shapeshifting occurring at the same time as a volume spike, the setup is validated. This final layer of confirmation ensures you enter after a price shift has gained sustained momentum, rather than guessing based on temporary chaotic fluctuations. Now, look at the market through this newly built system. On one side, you have the standard amateur approach, a cluttered screen full of conflicting data. On the other side, the exact same market is reduced to a structured blueprint. You identify the structure, wait for the level, and verify with confirmation. Even with precise execution, losses will happen. Trading is an exercise in probability, and no filter guarantees a win every time. But by applying these 3 filters alongside disciplined risk math, you shift the long-term odds in your favor. This is the transition from reacting to the market to executing a system. It is how a small account survives the initial volatility to reach the level where compounding can take effect.